Good afternoon, everyone. My name is Mark Anisi, and I'm sitting here with Paul Morrison, my co-founder for IRMAA Certified Planner. And today we are talking to Hugh McDonald of Atlantic College Planning. Hugh, why don't you get started by telling everybody a little bit about you, and then we can move on to how you found the client and what they needed from you.
All right, great. So to answer the original question, I've been offering college planning for over 30 years, and we get a lot of referrals in, especially from CPAs, divorce and estate attorneys. Once I show them how some of their recommendations in the college planning area for estate planning, divorce, etc., might actually end up costing their clients more money. So the clients that I'm seeing are referrals from either existing clients or from some of these professionals. The last couple of presentations that I've made, when I talk about college, it's very important to break the college process down into its four basic components. And those components are student loans. How much money what is the student obligation? That varies with each parent and with each school. So if I'm looking in this one case I'm thinking of, we were looking at $300,000 for a four-year college degree because the student had the potential to go to a very expensive school. Yep. And had the grades for it. So while we were talking about, okay, how much in student loans are going to survive the college process. And then we also talked about what's the realistic possibility of getting merit grants and scholarships. And then we took another look at, what are the chances of getting parent grants and scholarships, which are based on the parent's income and assets. And then finally, what would the parent obligation be? And when we got to the last section of what would the parent obligation be, we were still looking at over $150,000 in parent obligation. So I was able to cut the cost of college in half because of student loans, and to be candid, because this was a very good student to work with, and we were able to say there would be grants and scholarships available.
Yeah.
But as we started to look at the 150, we basically, I said, look, there's where does this money going to come from? Are you going to liquidate any assets? Well, you have tax implications. A lot of people don't realize you can take money out of a retirement account to pay for college. And if you're under 59 and a half, there's no prepayment penalty. And then there's also the recent changes with the Secure Act. And so we were able to talk a little bit about 529 plans, why I'm not a fan. And also talk about some of the changes that are coming with the Secure Act, with the Supreme Court justice ruling on affirmative action, and also with the pending changes on student and parent loans. So when we started talking about retirement, one of the things that became pretty clear, and it's not uncommon for me, I have clients who have no money put aside for retirement, $1 million, $2 million, $3 million, $4 million, $5 million, or more. But in order to pay for college, everyone is always concerned about retirement. And so it was a very easy way to transition in as I'm going through these figures and saying, okay, if you decide to pay for college out of your current income, well, not everybody has an extra $5,000 or $6,000 a month because colleges do allow for a payment plan. So we covered that, and that wasn't an option. There were assets that could be liquidated, but any assets that were liquidated were assets that were not there for retirement, which was going to be needed. Right. So we got to the point where it became pretty obvious that in order to preserve the assets that the family needed for retirement, we were looking at student loans and alternative ways to cash flow college. And that's when we stepped into the realm of what assets do you have in retirement? And, the one client, and there have been numerous ones, but the one that I'm thinking of had X number of dollars in present value. And we looked at that and basically said, look, if your if we're lucky and if we do some good asset management and we manage the risk and everything else, stocks, it's not an unrealistic model to say, look, if we do a really good job, hopefully we can average somewhere in the 7% annual rate of return over the next 10 years, which means the assets would double. And we covered the rule of 72. Obviously, it wasn't a guarantee that they were going to get any kind of return or anything like that. But I said, I said to one of the clients, I said, well, listen, and I'm going to do this as a hypothetical, but let's pretend they had $1 million in retirement, and that $1 million was able to double in 10 years. Okay, that goes to 2 million using the rule of 72. And then if we were lucky enough to repeat that again in another 10 years, that would be $4 million. And I just looked at them and I said, okay, now you're right in the heart of your RMDs, your required minimum distributions. And did you know that there's 2 expenses you need to be concerned about? Item number 1, when you pull this money out of your retirement, it becomes taxable income. And they weren't happy with that. They actually said, we've paid the government enough. I said, well, there's a second cost that you may not be aware of. Are you aware of the relationship between your Medicare monthly costs that come out of your Social Security before you get it? And they just said no. And I said, well, it's called IRMAA. And I briefly explained what it was. And I said, the government's going to be looking for this money. Do you want to pay them now, or do you want to pay them later? Would you rather pay taxes on present value of $1 million, or if we put together a good plan, you could have $4 million in retirement assets? What do you think the tax rate's going to be then? And they both, guys, I can tell you this has happened. Every time I do this presentation, they always say the same thing. Nobody else brought this up. And in the last couple of presentations, I've had clients say to me, we were searching for another another investment advisor, somebody who can handle the retirement. And on average, it's not in Northern New Jersey, they're getting hit with all kinds of promotional materials on, come to this lunch and learn. Here's our webinar. I've got my competition in Northern New Jersey is pretty impressive. And yet I've yet to come across somebody who says, oh yeah, somebody else talked to me about IRMAA. There have been numerous clients who have said, we've talked to 2, 3, 4 other financial investment advisors, and they never even mentioned it. There have been, now I'm not saying that there's anything bad, but depending on the RAA, depending on the client's risk tolerances and everything else, there are different ways to try to plan and preserve assets for retirement. But I'm not seeing anyone talking about IRMAA in Northern New Jersey. I haven't come across it yet. I'm not saying it's not out there, but I will tell you it's a great way to differentiate. It's enabled me to differentiate myself from other advisors who never brought it up.
Perfect. Thank you for that. Moving on to the next question. Obviously, you have differentiated yourself with your college planning practice. The question I do have is, did the inclusion of the topic of IRMAA help acquire this client, as well as increase the speed of acquisition of this client?
At the end of the appointment, the question is always, what's the next step? Right. And that is, how do we, what's the next step? And I tell them the next step is we have to do an assessment on this. I already have we use something called an EFC fact sheet. It's a 4-page document that they give us for college planning. So I already have a lot of the information I need. I can go into these meetings with an estimate of, what their costs could be. And I tell them, I said, look, this is not, you've hired me to be your college planner. If you'd like me to offer these other services, that's the next step in the process. So I already have their information, and it's pretty easy for me to run this and say, look, this is what you're looking at. The close rate is usually, I bring up IRMAA, and at the end of the meeting, it's always, what's the next step? What do we do next? Where do we sign?
So not to get too deep into specifics, but you're seeing the majority of people that you're talking to now about this, they want to move ahead with what you're doing and adding in that kicker of the IRMAA information and your ability to now model it for them.
Absolutely. Something that's a great term, to model it out. I'm probably going to use that because I'm a big advocate of that. And Paul, you've seen some of the Excel
Hmm.
spreadsheet that I sent you for college planning.
Hmm.
It's all about the numbers, and it's all about being realistic in dealing with the clients, but modeling it out. That's a great term. I think I might start using it. Yeah, let's model this out.
Hey, Hugh, Paul Morrison again here with IRMAA Certified Planner. Let me ask you a question. So do obviously this couple that you asked about IRMAA, they wanted to know, they were curious about what is this, what is this actually going to do to my retirement plan? We've interviewed, 2 or 3 other advisors. They didn't know anything about this risk. Are you seeing a major curiosity right now when you mention IRMAA to every prospect or client you come across?
I'm not being humorous here. I initially get curiosity and then a little anger. They're not happy about the fact that they've worked hard, they've got these assets, and it starts with, how do we preserve these assets for retirement? Leads right into RMDs. This is when the RMDs hit, and this is the additional costs that you may not be aware of. And yeah, it's curiosity, and then I'd use stronger language, but we're being recorded. I've seen anger.
Yeah, when you bring up the topic of IRMAA and you explain it to a prospect or client, what type of questions do they ask?
Usually they don't ask any questions because it's the first time they're hearing it. So I view my job, and I've been doing this over 30 years. I've always felt that my job is a teacher, because even if they don't become a client, they become a great referral source. So I'll spend a little more time with this. So the questions usually, the questions are just, how do we fix this? That's really the bulk of it. And, it's a simple concept. You work hard, you save your money, you plan for retirement. The government has set in place Medicare. You have to sign up at, 65, even if you don't use it. There are changes in Part A. I think Paul, you and I talked about the big changes that are coming in Part D with the Alzheimer's, the advances in Alzheimer's drugs, and the angiogenetic
Right.
specific cancer. I think everyone's in agreement that our healthcare costs are going to continue to go up, and you just show them, hey, this is what you're looking at. I do reference the Board of Trustees of Medicare. Paul, you and I have talked about it. I share with them some of the numbers. And usually I treat it as a class almost, whether they're in my office or I really don't go into the homes that much anymore. There's no need. But I have some clients that, because of their schedule, I have to. Home or office, they're hearing about it for the first time. And so they're looking for someone who has expertise in that can fix it. So I don't get a lot of questions. I just get a lot of, I didn't know this. How do we fix it?
Going back to that prospect with $2 million in investable assets plus, would you say that when you brought up IRMAA and you mentioned IRMAA to them, did that play a very crucial role in them becoming a client of yours?
Well, let me answer it this way. I think with this client, if I'm being really honest, it cemented it. It kind of brought it over the finish line. And I'm thinking of other clients where I've used it. And yes, I want to be clear about this. When you're talking to someone about college planning, you're on a very emotional level because you're talking about their children. And, it's one of the expenses where a parent will say, oh, I'll spend, it's so important. And it is important to, have your children get a good college education because, in part, because the difference between the income they make, if you only have a high school diploma, and you don't go into a trade or something like that, you're limited as to what you're going to make. That means you're limited in what you're going to earn and what you're going to get to keep. And in some cases, the difference between a high school, the income with just a high school diploma or having a college or advanced degree could be the difference between a $75,000 a year income for the student post, and when they enter the workforce, or with an advanced degree, it can be upwards of 250,000. So, it's a very, very emotional thing, and the parents, want to make sure that, they'll spend any dollar, but then when it comes down to writing the check, they obviously don't want to overpay. It's when they realize that this money is money that should stay in the family for them for retirement. And that's where what I call the IRMAA bridge comes in. Okay, we've saved this money. Here's something you probably don't know about. If we do a good job in college, we do a good job here. As I said earlier, here's your RMD. Oh, by the way, here's IRMAA. And I think, just pairing it with the RMDs to IRMAA and just explaining it. Yeah, I'm seeing a higher close ratio. I'm not getting I want to think it over. And I do have other clients who have interviewed like I said earlier, other advisors, and they're not bringing it up. So in answer to your question, yeah, I think this is, it's crucial. It's got to be part of their plan. And I think it is a very easy tool to use to show them the expertise in an area and get them to become a client. So I don't want to focus in on just the one client, but yes, I've had clients because of IRMAA who stopped talking to the best of my knowledge, stopped talking to some of the other advisors they were interviewing.
That's great. I know we got a bunch of time here, so if we're going to wrap this up, do you have any last thoughts that you would like to say for someone that's either interested in this or maybe even someone on the planning side of why they should or shouldn't get into this?
Are we talking about clients and or my competition?
Well, clients and or possibly other competition. Obviously, no one in the New Jersey area.
Okay, so to my competition, I don't want to tell them anything.
Perfect.
But let me rephrase the question to some of the reps to the other advisors who are in my office and to some of those that I'm training. I think this is crucial. I think it's for our clients. I'm introducing this to clients that were just college planning clients and coming back. And actually, I know we're going to edit this a little bit. The best answer is I didn't know about IRMAA a year ago, and I should have. And, Paul will tell you, I was shocked the first time we sat down and we went through this. And I just thought, all these clients I've given advice to, and I don't have an ego when it comes to this. I've called clients up that weren't clients, weren't assets under management or insurance or whatever. And I've said to them, hey, I have a new piece of information. I need to sit down and talk to you. We need to do it now. And I have clients coming in next week that I haven't physically seen, haven't needed to see, including doctors and so on. And they're coming in. And part of it is when I call them up and say, hey, I've got another piece of information, they know I don't waste their time. I'm very respectful of it. So to my clients and to future clients, this is another piece of the puzzle that is equally as important as, it's college, financial, investment, insurance, retirement, estate. This also has impact on your employee benefits, supplemental employee benefits. For my clients, it's now in my practice a crucial piece of the puzzle. To my competitors, I hope you never hear of it. To the people I work with, they will be trained in this because I think this is huge.